and then we can dive in. All right.
Okay.
We are live across the platforms. Jermise, just let us know if you see it hit across the platforms as it does. Folks that are listening and tuning in live, let us know in the comments where you're checking in from, making sure everybody can see and hear us, and drop comments and questions that you have as we go, and we will do our best to answer them. We're going to keep this super interactive because Dave and I have known each other for a while and we have these conversations often, but this is really great for other people to kind of be a fly on the wall and listen to this dialogue. And I think you guys are going to extract a lot of value from the conversation that we intend to have here for you. So again, like I said, Dave and I have known each other for roughly 5 years. He is my preferred lending partner, and we've done a lot of business together. And Dave, I'll let you do the intro. He's the co-president of Alpha Funding Partners, and like I said, my preferred lending partner, but I'll let him tell you about himself here.
Yeah, thanks, Gabe. Always nice to hang out with you, whether in person or on air. So Alpha Funding was actually Alpha Funding Solutions originally. My partner, Mark Colazzo, and I started that back in 2007. And we recently merged at the end of last year and joined forces with another group out in Long Island and rebranded under Alpha Funding Partners. But our business has been set up to back real estate investors from day one. We're investors ourselves, and over the years have both in fix and flip ground up construction, and now really we do a lot of multifamily, large scale multifamily that we own and operate for our investor base. But our focus has been on backing investors that are doing exactly what you do in terms of either building new homes, ground up construction, fix and flip, add a level, buy and hold, the BRRRR method. So our capital is really put together to be able to be a source for other real estate investors.
Yeah, okay. That's great. And that's exactly how you and I got started together on the fix and flip piece of that. And it was good that you touched on the BRRRR method piece, because we're going to unpack that in anticipation of our chat. Like I said, because you and I do this a lot, I wanted to get some questions fed in from the audience, because I know what you and I tend to talk on, but I didn't want it to be solely one-sided, and I want it to be of value to other people too. And so we got questions tied to the BRRRR method, which isn't something that I necessarily do in my business model, but I know it's something you do. So we'll unpack that together. I'm thinking maybe we start at the beginning, kind of with an entry-level investor looking to borrow. What do they need to know coming in? What differentiates them from other operators? What are you guys looking at? Originally, where were you looking? And now what are you looking at when people are coming in with a deal packaged for you to show
Sure. You? So I'll touch first on pre-COVID, what we were doing in the lending space, and a lot changed after COVID, and I'll dive into that right after. But historically, we were doing 90% of purchase, 100% of construction. We work with a lot of first-time borrowers. We really took pride in building those relationships and helping them grow their businesses and be a capital partner. We were doing 100% financing for really experienced repeat borrowers. I believe you're one of them, but that we've done some 100% deals. That all has changed. Some requirements have changed. So what's different today? What's different today is it's going to require you to bring more dollars to the table instead of 90, 100. That, and I'll use an example so it's helpful for people. Let's say you're buying for 200 and you're putting 50,000 in renovation into the property. Pre-COVID, you would bring 20,000 to the table, and we give you everything else. You pay for your closing costs, and you're on your way. Today, that same deal, you have to bring 20% of the purchase price, which now doubles that amount. On that deal, you'd have to bring 40. And for people with less than 3 deals, you'd have to bring 20% of the total project cost. That means you'd have to add in that 250 amount and double it. So that would be 50,000. And we're seeing this as a pullback across the board. We manage and control our own capital, but a lot of the dictation comes from a lot of the institutional money that has most of the other lenders broker through to, and they've set some of these guidelines. We're a little bit more aggressive in some fashion than a lot of what's out there, but you will need real and more actual dollars. So that ties in, and maybe we all chat about it later, about being able to raise capital to opportunistically take advantage of opportunities that others can't, or having fresh capital on the side. So the down payment has been affected. Other than that, we're going to look at liquidity a little bit more. We used to never look at bank statements. We are requesting 3 months bank statements now, because this is a liquidity crisis. It's not a credit crisis, right? The credit of the borrowers and the deals are likely to be the same, but for the capital that gets put out in this space, it's important that the payments come through. So we're trying to solve for making sure that someone has the wherewithal and financial capability to do that. So we look at 3 months of bank statements. In some cases, we're requiring 6 months of prepaid interest at the closing table. And so we'll model that out for you. And that's really basically the interest as deployed. We're working right now and likely will waive that, but you'll still have to show some proof that you have the ability to cover the debt service. So we're looking a little bit more heavily at that, because this is a liquidity issue. And so we can't take the risk of putting new dollars out only to have the loan not paid in the beginning. So those are the two biggest changes that are going on right now. And I don't know if there are questions on that, but that kind of really touches on the two biggest issues that are changed.
And you touched on it as you were going through that, and even a little bit before we went live, about how does a borrower who in the past would have come to the table with far less now still present themselves as a fundable borrower. You said something beforehand about trying to raise that gap funding privately to be able to then get the balance through you guys. And can you talk a little bit on that then?
Yeah, I mean, this is a huge opportunity. So I think people, and Gabe, I've known you, I feel like it's longer than 5 years. But what's amazing about following you and seeing what you've done, and you've been dedicated to educating yourself every step of the way and sharing that with people in your sphere of influence and beyond. And that's very admirable. And I'm not to go off on you, but I'm thankful for the relationship. But I think right now, the big opportunity is there's always the people that say, oh, this is ridiculous. I got to put 20% down now. I want 100% financing, and they try to go around. The money doesn't really exist, with the exception of maybe a needle in a haystack with a private lender. And if you can find that, great. But outside of it, this is a huge opportunity. And the reason why is the people that recognize, hey, look, lending has changed. Other things in the world have changed because of COVID. Lending is no different. And what's changed is some of the requirements. So when you understand what the new requirements are and you can put a plan in place to solve for it, you're going to be steps ahead of all the other people that complain or say, I can't get the money, or I don't have that dollars and I don't know how to raise it. Why? Because I believe that there's going to be a lot of opportunities. And it's not just this year. I think a lot of the challenges from COVID are going to rear its ugly head in 6 to 36 months. And there will be a good stream of inventory to come. But you won't be able to capitalize them unless you have your own dollars to meet the requirements for your lenders, or you're able to raise that. So what I'm suggesting to people right now, even people that have money, capital raising should always be a part of your business. You should always be thinking about investors that you can bring in. It's just as important as looking for deals. That's building relationships with companies like us, knowing we're there to back you and understanding what we need to write a check to back you on your deal, and then filling the gap on the other. If you have a lot of your own money, you don't have to worry. You can say, oh, 20%, that gets me, I have $500,000, you multiply that times 5 and I can go out and do, $2.5 million in deals, right? But if you don't have that, you need to focus on building capital. And maybe you want to touch a little bit on how you've done that. I can add some color on that as well.
Yeah, I think you touched on two really powerful things. One is it's not really about lack of resources. It's about lack of resourcefulness on the borrower stamp, on the borrower's side. It's out there to be had if you go after it. And if you align with people that are out there doing good work, you'll find the monies. The other piece is the concept of relentlessly fundraising. It's something I teach on all the time at the foundation workshops and on the bus tours and stuff. It's, you always need to be 3 times oversubscribed. You need to be constantly having dialogues with your private money partners, with your hard money partners, because when you need the money, it's not a time to go get ready. It's a time to be ready. And so what we've done beyond that, I mean, I get real analytical about it, real systematic about it. Like, I'm having 2 relevant private money lender conversations each week. It's one of my scorecard metrics, and I report into the team on that every Monday. And so if I haven't had 2 relevant dialogues with private money lenders to gap fund the stuff we're talking about, then I have to explain to the team why that didn't happen. And it's as simple as that. And that starts in your sphere. And then over time, by virtue of the fact that you do what you say what you do, you document your journey, people will start coming to you. It starts to become more of an inbound thing than an outbound thing. That's been my approach to it. I mean, I'm only one of many borrowers that you guys have. So I'd be curious to see or hear from you what other borrowers are doing that's working pre-COVID, and maybe even now, if you have some insight, what are they doing that you're seeing that's been most effective?
You mean from the capital raising standpoint?
Yeah, to get that gap monies, because if our intention was to come to the table with the 10% and do more with less to use the leverage, but now we don't have it. Now it's okay. Now you have to bring the 20%. If you haven't done 3 deals, now you've got to bring significantly more than that. You need the interest reserve piece. So what's your guidance on that?
So I'll share my thoughts, and I'll ping the idea of what I've heard from other borrowers. So I don't get ultra granular with each of the borrowers, but I've had a lot of discussions where they, it seems like a lot of the very experienced investors always have 1 to 5 different guys that they're constantly talking to, and that they're bringing in on deals, because they'll say, oh, I have my investor that's partnered in on this, or their silent partner, or whatever. So we see that. I think more meaningful for everyone listening in is what do you do if you haven't raised capital? Obviously everything's easier if you've done deals before. And I always stress, and I know you have too, is documenting what you're doing, how you're doing it, why you're doing it, where the risks lie. And it could be a simple PowerPoint or whatever, and go through that exercise. And there's plenty of things online you could probably see on Bigger Pockets, or search a deck for presenting to real estate investors to back your fix and flip. You'll find different things. But the most important core pieces of what you need to do is present yourself in a manner that you look in the mirror and be like, I'd want to invest with them. This guy's thoughtful about what he's doing. He's looking at the numbers. He's focused in a specific area. That doesn't have to be, but the more you can focus on what you're doing and why you're doing it, builds confidence. You want to relay how you're going to communicate with them, and what their share of it can be. And this could be a whole different discussion, but there's a lot of ways to skin the cat as far as how you pay them. And what I've typically seen is one of 2, and there's hybrids, but they're either debt or equity. So what is debt? Debt means, hey, you'll put this money up for me. I need $40,000 for my lender. I need about $15,000 in working capital to cycle through for ordering materials, and I need X dollars for payment. Let's call it $60,000. Mr. Investor, for putting up $60,000, here's where I'm using all your money. This is for this. Maybe you put up a percentage of it, like you put up 6,000, they put up 54, so you're putting up 10,000. So there's some alignment of interest. And then from a debt perspective, you would say, hey, look, at the end of the deal, what's going to happen is after I pay the lender, you'll get all of your money back first, and then I will give you X return on your dollars. Now that can be negotiated. The lower, the better for you, but you also want to do it at a blended place that they want to keep coming back to the well. So maybe you pay them, they're giving a small percentage of the whole pie. So maybe you say 8, 10, 12%, whatever you can do. And then you pay them that and you keep the rest of the profits. The equity version of doing that is saying, hey, listen, when I go ahead, you're going to be partners with me on this deal. I think that the profits look like X. There's $80,000 in profit. And for you putting up the 60,000, I'll give you all of your money back first. And then I'll give you 30, 40, 50% of the profits. Now, we all know deals don't always go according to plan. And sometimes you're over and you sell for less. When they come in as equity, you may give up more profit, but you start earning money earlier on because you're not guaranteeing that return. You're just doing a split on profit. And then you can blend them where you say, look, I'll give you a 6% preferred return on the days your money is out, and then I'll give you a smaller sliver of equity. So now you're giving them almost the first guaranteed dollars and then a split. There's no right or wrong way, but at the end of the day, you should be honing your skills on raising capital and marrying that with a lender. And I guarantee you that you are going to be able to capitalize on deals that a lot of other people can't, because you have your lender, you have your gap, and those other folks that can't come up, you're not competing against them anymore. That was the big problem before this COVID, was that everybody and their brother woke up after watching a fix and flip TV show and decided they're flipping a house and overbidding on properties. There's going to be more margin for the experienced guys, and you're going to pick up at better discounts. That the excess cost of capital is going to become minor. You're going to be in a better financial place. So, and I really believe that. So,
yeah, you know what, you articulated the differences between debt and equity brilliantly. I think that's going to be powerful for people. The concept of aligning interests with yourself and your borrower, equally powerful. And I love how we have the whole dialogue, the whole tone of our talk is meant to be optimistic, because we both genuinely believe that we are headed in the right direction. Good things are coming down the pike. There's a lot of people that have been in the space that we don't expect will be here later. Their intention wasn't to play this long game. And I think this will be telling of that. But the opportunity piece you just alluded to, let's unpack that a little bit. Let's talk about why we suspect that we're going to see that going forward. What about what you're seeing already is suggesting to you that there's going to be more opportunity?
So, this is a great subject, and you can chime in too. We did a state of the market right after COVID broke out, and I brought on two of my partners, one who's on the advisory board for Fannie and Freddie Affordable Housing, the other who's my partner in our real estate private equity group that, had worked for the Fed and done, work more in institutional real estate finance. And at the moment, and the head of RMS title and appraisal. And so the head of RMS was saying, hey, look, right now there's no data. We don't know what's going to happen with real estate values. And that's why a lot of lenders pulled out. There's this crazy uncertainty. But what's been developing over the last several weeks is some data and some understanding of what's happening in the marketplace. And so what's happened in the marketplace is a combination of things, right? Before COVID, there absolutely 100% was a shortage of housing in the market, and especially affordable. And I'm not saying like workforce housing, but for people making 70 to 150,000 that want to buy a home that's, the median price home in any area in the Northeast, 400 up to 600,000. And each town's a little bit different. So there was a housing shortage before. There's a bigger housing shortage now. Housing starts have slowed drastically. Builders can't put shovels in the ground. They don't want to. The lenders that are out in the marketplace, I just got a call last week from one of the most well-heeled builder developers in Monmouth County that was borrowing from a bank. They were getting 70% and 100 from the bank. They've been a generational builder. they've got great assets, whatever. They are not able to move forward on a lot of deals because the banks said, listen, if you want to go buy the land, we'll fund the construction. Well, that's a leverage point that doesn't work for them. They can't do that because the prices that they're buying these properties, their demos, are 400 to 600,000, right? So housing starts and from the builders have been down. So there's no new supply coming. Now what happens is we now are dealing with COVID, and sellers don't want people in their house, right? They're terrified. And my belief is that a lot of sellers, even as the doors of the world open up, will not want people in until we come out with a vaccine or we get through, there's a lot of talk about being another cycle through the winter months. So my belief is right now we're starting to see data tick up. There are increased prices in a lot of markets and is really good for our fix and flip investors, because if you get your house on the market and it shows nice and it's staged and it's vacant and agents can come in and out, we're seeing a lot of bidding wars. I mean, you'll share your story in a second, but this morning I got from one of our really strong repeat borrowers, we had an ARV value of 485 that was done obviously pre-COVID. They just closed on the house for 550. Now maybe they did a little extra work here and there, but they had 6 offers. My partner was bidding on a house recently. It was 825 house. There were 10 offers. He was over 25 over ask and lost the deal. Cash offer. So we're seeing this all over. So my belief is that prices are going to remain strong until the floodgates open for sellers to move. And I think that won't happen until we get through the next winter season. It may happen next spring. At that point, maybe we get a glut of inventory and prices move down. But if you're underwriting your deals and building in a 5 to 10% reduction in sale price, you're going to be in a really good position, especially if prices don't move. And the last thing I'll say on that is that mortgage rates, residential mortgage rates, remain at historical lows, and I feel very strongly that residential mortgage rates are going to remain low for the next 5 years. It may move up some, but it's going to keep the market moving. There'll be some hiccups or losers along the way, and I think the biggest challenge will be some of these people that do a forbearance agreement with the residential mortgage, don't absolutely need it, and when they have to start to repay based on the terms, will be far behind, and maybe their job situation didn't come back, and now they're going down a bad path that they can't recover, which is going to present more foreclosure, short sale opportunities for investors like you and the people listening. So I know you were telling me before, maybe you echo what I was saying with where the market's at right now.
Yeah, our finished vacant project listed as of Friday saw 2 offers over the weekend, 2 more coming in as we speak. We'll likely have 5 offers in 5 days on a vacant home. Because of that, I think it just has to do with the fact that people can get in there, and anything on the retail side that we're seeing that's vacant is getting a ton of action. So we'll echo that. That's what we're seeing, and that just we're not talking about. This isn't crystal ball speculation. This is data, not drama. We're talking about real data. These are real things we're seeing, and of course, things are evolving quickly. And so this is what we see right now. We're talking to things that are specific to what we have in hand right now, and that's all we can do. We can say, hey, we suspect this is coming down the pike, and here's the data to support that. But we could have this conversation in a couple of months, and things might be a little bit different. But at the end of the day, those that are leaning in to the market of the moment will be able to leverage these opportunities when they come, and if they're ready, they will be there. If they're not ready, then they'll miss this boat, and they'll look back on this and wish and hope and like everybody else, right? Nobody ever looks at 08 and says, I wish I bought less. Right. So don't be looking at 2020 and 2021 and saying, oh man, I wish I had done this. I wish I had done that. Like the time is now to go and do. So yeah, absolutely echo that. I wanted to drive home the point data. We're talking about real data. This is what's actually happening that we're seeing. These are texts. These are real offers. And
yeah, so, that data, just to add to that point, super fast. Rich, who was on from RMS Statewide Title and Appraisal on that first webinar, I follow up with him. We had recent conversations, and he's saying that they are seeing price increases in a lot of the markets, and a lot also coupled with the shortage of inventory. You have a new supply of buyers or demand because you have a lot of people fleeing the urban areas that have money to move out. So some of that may artificially increase for a little bit, but there's still that underlying demand, and values are holding. So
yeah, that's so let's transition then into what we alluded to earlier about the BRRRR method and the refi model and the product that has, again, I could be speaking out of turn here, but that product's gone away for now. Can you talk on that and what those guys are doing, what you're seeing on that side?
So stuff is definitely changing day by day. When COVID hit, we continued to lend fix and flip from day one till today, and we're continuing. And we kind of went over those guidelines, and our team is set up. And one of the things I take a lot of pride in, I'm going a little off topic, is that we are upfront and clear about what we can and can't do and where challenges might lie, to make sure that the investors understand what's going to happen. And as we've done that, we relay that in real time to our borrowers, because it's important. Like I said, we're partners with our borrowers. So as far as the refi market, in the private world, where a lot of people were refinancing, because the attractive part about going with private term loans, meaning 5 or 30 year with a 20 or 30 year amortization, is that you had lower DSCR, debt service coverage ratios. You didn't, or have lower seasoning than the banks. There are bank loans that still are out there, but some you need to be not in an LLC, and those can be explored. The challenge is with that, if you're building a portfolio, you are taking on a certain level of risk by not keeping that property in an LLC, because obviously you're exposed personally. And people don't really think about risk until they get whacked in the face with risk that they never expected or thought could even happen. And when a guy like me, who's a lender and sees a lot, tells them, they're like, "It can't happen to me" syndrome. And trust me, I live in that world. I've changed a bit as I've gotten older. Had plenty of mishaps along the way because I thought I could do something that I couldn't, or not with bad intention. But those still do exist, but the banks, most of their capital is going to PPP money, which is backed by the banks. They're making really good profits on it, and they need to focus their energy there. So writing these loans become less of an issue. The private money, which was very active pre-COVID, completely evaporated for a period of time, and we're starting to see it creep back in. We just are relaunching on our hold program and bring new deals in. We're actually doing a broker and non-QM webinar tomorrow night that we're going to dig in deep on that topic. But there is absolutely money coming back in. But what the difference is that you're seeing the cost of the capital starting at 7 and a lot of stuff at 8. So it really begs the question, if you're going to have an investment property and maybe this loosens up and rates drop, if you're exit to refi, you need to model in what it looks like with these new costs of debt. Now, today versus when you stabilize the property in 6 months, we could see a big difference. But if you have to make the decision in a vacuum of today, you want to do it with what the worst case scenario is. Alternatively, what we've been suggesting to people is we do think that maybe rates will come down. This is opening back up, but what I do believe is that you will need to make sure that you do have a multiple exit strategy. If in fact you cannot refinance, or the cost is prohibitive to making it a good long-term investment, you have to be ready and willing and able to sell. Now, keep in mind, the next person buying needs to get certain types of capital, so it can devalue that. So we are seeing the money come back in again. It's a little bit tighter, and I think with time that should loosen up.
And so and you guys are unpacking that on a webinar tomorrow, just coincidentally.
Well, we just started moving some new deals forward in the past week, and so we're working on getting those fully approved and moving forward. And we're going to come out in a big way with that, and it's definitely needed. And we'll engage with our borrowers when they're bringing us a deal, what we can do for them on the exit as an option, but they'll be going into that tomorrow night.
Okay, yeah. Well, as we wrap up the call, we'll throw the link up and share it. One thing you touched on, I want to kind of backtrack a bit with regard to the do what you say what you do kind of concept, and how you guys are very forthcoming about what it is that you're expecting of someone coming in. Because I made an introduction, and I was on a call with Matt last week, and he was very clear about what it is that your expectations are. And so I've had a relationship with you guys for a while, and so we have different kinds of dialogues because we've been doing this together for a while. But when I make an intro and somebody's green and right out of the gate and about to do their first deal, even if it's a deal that I modeled and gave them and said, hey, this is a deal I would do, go for it. But then you look at them and say, hey, the deal is great, but here's what we need from you as a new borrower. And he was very clear up front about what your expectations were and why this borrower would not check all those boxes. So kudos to you guys, and it's not just you saying it at the president's level, right? I had a conversation with Matt where he said it and was very clear about it. So you guys are definitely cascading that message internally really, really powerfully and effectively.
Yeah, I mean, and even in all of our email communication, we lay out what we can't do in big, bold. People tend not to read stuff, which I've learned over the years. Yeah, when you're trying to close the deal, you ask them for stuff, send an email 5 times, and they're like, I never got it. And you're like looking at it. But in every way, shape, or form through our communication, we're trying to deliver as clear and detailed messaging, because you know what? We understand you guys are making big financial decisions based on what we can do. And if it's a shade of gray for us, we're going to lay out that shade of gray. And I'm not saying, look, there's plenty of other good lenders out there, but there's a lot of other lenders in the market that will tell you that we can get something done, and they hope that they can, but they're, a lot of them are brokering through to some institutional stuff, and they don't have control over the underwrite or the exact piece, and it can get pushed back. So at the end, maybe they don't do it with intent, but they leave you hanging or retrade a deal. When COVID hit in that first week, there was a couple things that got changed so fast on us that we, with our managed capital and our own private capital, that we had to make some quick moves, but we reached out to the borrowers and explained, and but once we dialed in, which was quickly, we started to message this out. And I think it's important because you're trying to build a business and make investments, and we're a big part of that for many investors, right? So
yeah, I know exactly. And we had those conversations right as this all was happening. Were those terms going to be refreshed, and if so, why? And you were very clear about what was happening, and it was seemingly by the minute things were shifting. So this has never happened before, not in this flavor. So we're obviously all kind of working through it. Thankfully, things have seemingly settled down a bit. And so I got equally as many questions on the front end, on the positioning yourself as a good operator to make yourself and your deal attractive to a lender, as I did on the non-QM stuff with Burr and the refi and where that's going. We've touched on the market piece, what we're seeing, what the data is dictating right now, and what we anticipate is coming. We talked about just essentially keeping your word, just do what you say what you do, and then that goes a long way. That's doing business 101. And so as we wrap up and we're approaching kind of our time together, I want to be respectful of your time. What's your kind of parting piece of guidance for your borrowers, the folks that are in the, that are on live and will watch this later and are looking to partner with you going forward?
I think the simplest and best message I can relay is that we're here for you, and we've been around a long time. We're going to be here for a long time to come. If you have a deal or a scenario that you're unsure of, or you're ready to move a deal forward, give us a call or shoot us an email or go to our website and click on any quick pre-approval link. We've built lots of good quick funnels to get to the right people within our company, be it myself or the rest of our sales or underwriting team. We'll quickly get on the phone with you. We'll look through your scenario and we'll take you quickly and easily. You'll know what we're going to do and how we're going to do it, the steps from hello to a closing table. And if there's going to be challenges, we're going to let you know. So you can call our office. You could call 732-657-2014. You can visit alphafunding.com, and we have these quick pre-approval buttons. It literally takes 30 seconds to fill out, and one of my team members will reach out to you. You can put a scenario. You don't have to have a deal, but just connect with us, and we're here. And listen, if we're not doing business today, that's fine. Like we just want to be able to explain what we can and can't do, and if the timing's right, we'll step in and work with you. So.
Mm-hmm. Yeah, I've always appreciated that about your willingness to sit down and educate borrowers, me being one of them. And it's afforded me the ability to grow my business, because what I wanted to do next, you were there to kind of guide me through it and tell me why it does or doesn't make sense. You could have easily made a loan on a deal that works out for you, but not me. And so you guys don't do that. It's not how you operate. Thank you for that. Kudos to you guys for that. So you told us where we can find you, and plug the webinar because I think it's really awesome. It's timely and coincidental how it's happening tomorrow. But tell us where we can find that, and let folks know.
Okay. Yeah. So there's two ways you can go. You can go to alphafunding.com. We have it on our homepage. You can also go to Alpha Funding on Facebook. If you scroll down, you'll see a link to the event. I could also give you the actual link to the event, and I don't know if I can post it up here or how we do it, but I could read it off.
We could drop it in the comments. That way it pushes across all the platforms, and then folks can just click through.
Live comments. I'll see a little. I'm slightly low tech, and I see the live comments. I see Ben Joannis. Thank you for loving us, but I don't see a spot to write in on that section. It's weird. I would say I'll just read it out loud. And again, you can go. It's on our homepage, and it's also on Alpha Funding. It's on Alpha Funding Partners on Facebook, or you can go to HTTPS. // I don't know if you have to enter all that part first, but it's bit like bit.ly /alpha broker. That's bit.ly /alpha broker. So you can do that. You can go to our homepage at alphafunding.com or go to Alpha Funding Partners on Facebook and sign up there.
Awesome. And we'll put it in the links too. We'll put it in all the comments across all the platforms, so it pushes through. Folks can click and go check it out. And thank you so much for being so generous with your time, and as usual, being such a wealth of knowledge, being so open and honest and humble. And I appreciate you and honored to do business with you. So thank you, buddy. And
thanks. And look forward to being able to grab a drink again sometime soon.
Yes, when all this is over and we can all get together, share a meal.
Yeah. break some bread. But thank you, and thank you for everything you do. And not to sound corny again, but you are an inspiration to a lot of people, and you've built a really amazing business. And I love how dedicated you are to process and to systems. And if everyone takes a little bit away from that, it'll be helpful.
Yeah, thank you, brother. Appreciate it.
All right, take care.
Yeah.